Hello, my name is Rachel from Strategic Solutions Chartered Financial Planners. I'm going to talk you through a lesser-known investment vehicle called Venture Capital Trusts, or VCTs. VCTs are a HMRC scheme to encourage more investments into small UK-based companies. By their very nature, small companies are considered riskier than traditional investments. They need capital to grow, and given the right management and economic environment, they can grow into the large companies of tomorrow. To encourage investment into these companies, HMRC offer attractive incentives if you invest into them through VCTs. VCTs attract 30% income tax relief, tax-free dividends, and no capital gains tax on exit. In order to offer these tax advantages, the government do place some restrictions on VCT investments. You must hold the VCT for 5 years, and sale within this period would lead to the income tax relief being clawed back. The companies that the VCT invests in cannot be worth more than £15 million before the investment and £16 million immediately after. The restriction on size of the companies that can be invested in means that many of the opportunities available are in unlisted companies or AIM-listed stocks. These can have reduced liquidity and therefore could be deemed as high risk. Despite the attractive nature of the tax reliefs that VCTs offer, they aren't suitable for everyone. As the saying goes, you shouldn't let the tax tail wag the investment dog. When considering the suitability of a VCT for you, Strategic Solutions will assess your attitude to risk, the risk you're willing to take, your capacity for loss, the level of risk you can afford to take without impacting your standard of living, and your knowledge and experience of the investment product under consideration. This will then enable us to decide whether we are able to recommend VCTs as part of your overall investment portfolio. Most importantly, VCTs are only considered when more traditional allowances, such as pension and ISA contributions, have been exhausted. The following are some of the main risk factors to consider when looking at a VCT. Governments can and do change the rules on tax in respect of investments such as VCTs. VCTs are high-risk investments, and there may be no market for the shares should you wish to dispose of them. The market for these investments is likely to be very illiquid, particularly in the early years. In addition, you may find it difficult to realise the true value of the investment. Although the VCT itself is quoted on the stock exchange, at least 70% of a VCT's capital must be invested in unquoted securities or AIM stocks. The maximum income tax relief available is 30% on subscriptions for new VCT shares up to an investment amount of £200,000 per tax year. This is a tax reducer, meaning the tax must first have been paid in order to benefit from the relief. However, HMRC will reclaim this tax relief if the shares are not held for at least 5 years, or if the VCT is deemed by them to lose its qualifying status. VCTs typically invest in unquoted shares, for example in the new shares of privately owned companies and the new shares of companies traded on the Alternative Investment Market, or AIM. As such, these investments should be considered high risk. The availability of various tax reliefs should not cause you to overlook the risks inherent in such ventures. Hopefully this video has helped to highlight the features, benefits and risks of VCTs. If you would like to discuss this further, please contact our advisors who would be happy to talk to you about your financial plans.